Today we're doing mortgage lending in a changing market. And as Keith and I were talking a couple minutes ago, it's changing by the minute, right, Keith?
Yes, ma'am.
So we said today we're reporting it's April 29th and it is 4:00 p.m. in the afternoon, Central Daylight Time. So what we say here is what's happening today. And it's important to know that because that's how much mortgage is changing by the minute.
Absolutely.
Okay, so how old's this grandbaby out on the deck playing with Barbies?
9 years old.
9 years old, they still play with Barbies, huh?
Oh, yeah. Well, they never do. Girls ever stop playing with Barbies?
Yeah, they turn into Barbie, huh?
Well, I know I've seen a couple things where it's ladies in their 30s and 40s have Barbies collections that are worth hundreds of thousands of dollars. They have the old Barbies and they still have them, even though they're not in boxes. They're still worth a lot of money. So
I have a friend, and you'd be surprised. She has an entire 2 rooms in her house are Barbie and other memorabilia toys. I'm sure it's worth a lot of money with the whole playhouses and all the characters, the Disney, this, that, everything.
yep. I have a client who's closing tomorrow that it's the wife, not the husband. The wife has a Hot Wheels, the little car collection, and she has thousands of them. She just wanted to get rid of them. They didn't want to move them. She put them on eBay or whatever it was, and she got $44,000 for Hot Wheels.
And the husband wanted her to get rid of them, right?
Well, he didn't care. She just didn't want to move them because there was so many of them. There was thousands of them. There was one room from the floor to the ceiling, all 4 walls. They built little shelves and they had the Hot Wheels all on display, and they were still in their little boxes and everything, but they thought it was too big of a deal to pack them up. She said it'd take longer to pack and move those because they didn't want to stack them on top of one another and everything else. So, but one never knows what something's going to be worth until you go and throw it out there, and $44,000 later. So I just told her not to put the money into the account yet, because then we'd need an explanation of a large deposit. So
yeah, don't put the money in the account yet.
Not yet. Put it in after we close.
These are mortgage things that, buyers or sellers don't think about.
Nope.
Don't put them, here you got $44,000 from a whole bunch of, but how did people pay her, from Venmo or?
I have no idea. I didn't get into it. She just told me, and I said, do not put it into your checking account. So
because then you're going to have to explain where did $44,000 come from?
Well, we've talked, there's people that go out, if they're closing on the 30th, in the afternoon, in the morning, they would go to Home Furniture, which they probably can't do that now because it's closed, but they'll go out and buy $25,000 worth of furniture. And the minute it shows up on the credit report, which is in seconds, it causes a delay in the loan. So people say, when can I buy something for the house? And I always tell them when they hand you the keys at closing, because at that point it doesn't matter. But until they hand you the keys to the house, you can't buy anything. So
that is amazing.
Yep.
That really is. Okay. So we are coming up on the hour. In fact, we're there. Okay. So I am going to begin. I'm trying the going live on Facebook again, but I think it'll work anyway. So I just want to welcome you folks to the mortgage lending in a changing market. And we're talking about a COVID market right now. Again, I want this on record. It's April 29th, 2020, and it's 4:00 p.m. And I was just chatting with our guest here, Keith Lis. And he says, this is changing by the moment. I'm sure when he wakes up in the morning, he has to see what are the rates and what's new. So we're getting a live report right now, and you're going to be able to ask questions. So that's what's cool about this, especially if you're right in the middle of the mortgage process. It's tenuous right now. So welcome to LeAnn Riley's Investing Club. I want to just say hi to everybody and mention that we broadcast live. I've been doing every week now for the past 5 weeks with expert speakers that are leaders in real estate investing. And you can ask questions and participate from anywhere. That's what's cool. And the truth is, you don't need a ton of money or knowledge to get started as a real estate investor. You just need to know the right formulas, and you need to follow a system to be a smart investor. I'm LeAnn Riley, a broker and a real estate coach who helps clients buy, sell, and invest. And I lead the Encore investment team of realtors in the Twin Cities, Minnesota. And I know there's people here from all over the US. I built a multi-million-dollar real estate portfolio in residential, multifamily, condo development, commercial, and vacation properties. As a national coach and trainer, I help ambitious people build wealth as real estate investors with my proven profit formula coaching program. I provide a lot of free education like this we're laying down right now, our live stream with LeAnn Riley's Real Estate Investing Club. And I'm so glad you're here today. And I want you to say hi over there in the chat box. That's how we're going to communicate and get the questions here later today. Okay, so good. I see Renee's here. Good. Now I know everything's working. And today we have a really special guest, and his name is Keith Lis. And yep, he has white hair, just
It's
like
blinding.
you can see. And he is from People's Home Equity. And with the economy in this unprecedented territory, and people are worried about a housing crash, I want to find out from Keith the inside scoop about what's happening in the mortgage market. And I'm sure some of you are interested in the same topic. Okay, so first I want to tell you how I know Keith. I have known Keith for well over 10 years, and he has helped hundreds of people figure out the complexities of the mortgage market. And he matched them up with the right product to get them a loan that works, because we're all different. Just like real estate investors, everybody has a different position. And I have sent so many people over to Keith who were unable to get a mortgage, and with his perseverance and his skills in this business, because he's been in it a long time, he manages to get the job done. And it is a great day when I see a happy homeowner close on their first home or their investment property because they got it together. So in addition, his company handles mortgages in any state for you people who aren't from Minnesota. And I have sent him many out-of-state buyers too. So welcome, Keith.
Thank you.
We are excited to chat with you again. Anything I missed? What do you want to tell us about your experience level?
Well, I think you covered it all pretty good. I mean, the bottom line is I am familiar with a vast array of products from first-time home buyers to investors. So I have access to 30 different lenders. And like LeAnn said, that the advantage of that is if it doesn't work for one investor, you move on to the next one. In 21 years of doing this, my closing ratio is 99.9%. So it means if I start it, we're finishing it. So the only ones that usually don't close are when somebody does something at the last minute on the buying side that messes things up, like quitting a job, buying furniture, buying a new car, making a large deposit we can't source. But if they follow the instructions and we go through and have a lot of communications, the loan process can be fairly smooth and easy once we find the right product. So
that's great. That is what I like about working with mortgage brokers, because they're, even if people have really great credit and everything appears to be okay, I've done enough real estate deals that all of a sudden there's a gog in the system. And so it's really great to have somebody who can keep it together. Like me as a realtor, I'm pretty good at keeping it together. So when I work with someone like Keith, together, we really got this for you. So if you're thinking about buying or selling, we're a great team, the Encore investment team. So how the program is going to go today is I have a lot of questions. And since I'm in the real estate business, I kind of know what to ask. So I'm going to ask questions, but we're also going to let you guys ask questions, but yours will be sort of more toward the end, because maybe we'll already cover what you're thinking. I see Kelly, let's see, wants to invest in Tennessee, but That works too, right?
Yes, it does.
Okay, so first I'm going to take a poll. I want to see who's here listening today. So I'm going to put up this poll, and what you do is you just kind of vote here on where are you in the real estate investing process. Okay, and people are taking the poll. We want to see who we're talking to. So we got some just getting started people, some buy and hold folks. There's a realtor on here. Always like to see realtors. You know, we as realtors need to know about mortgage too. That is for sure. Somebody's got some turnkey rentals. That means they bought them, they're all ready to go, and they get the tenant in there. And we even have a wholesaler on here. So we got a little bit, but the winner almost always is people just getting started, because it is a bit confusing when you have to figure out how to get started. Okay, I'm going to end that poll, and I'm going to share the results so you folks can see what the voting is. Can you see it?
Somebody asked what a BRRR is.
BRRRR. That's buy, rehab, rent. What's the next one? Rinse it, refi, and repeat. So yeah, there's a lot of the millennials love that strategy. I have a whole live stream on my YouTube channel talking to a guy who's done the BRRRR strategy, young kid in his 20s, Evan, and he makes it, you know, he has, you know, maybe 20 units now, just doing, you know, he was house hacking and BRRRRing all at the same time. So it's an interesting strategy. All right, you ready, Keith? Here we go.
I'm ready.
So I got some big questions here. Are mortgage rates going down?
Not immediately, but they're stable right now, because as recently as 3 weeks ago, a 30-year fixed mortgage was over 4%. They're down in the mid threes again, and that's been fairly stable. Projections are, though, as we come out of this COVID-19 quarantine, stay at home, shelter in place, that we could see the rates dip below 3 early next year. But that's just a projection. And again, that could change. That was in a meeting yesterday at 9 o'clock in the morning. The rates are, like I said, they're stable. I've got somebody I'm working with right now, 20% down, 30-year fix is 3.375 with no points. So that's a pretty darn good interest rate.
That's a pretty darn good interest rate. Wow, in the threes, you guys. That means like, wow. What people don't realize is with those rates so low, you can buy something a little higher.
Absolutely.
Yeah.
Let's add one caveat to that, though. If it's an investment property is going to be in the low to mid fours. So 3 rates that start with 3s are going to be for your primary residence. If you're buying an investment property, your rates are going to be in the 4s, which is still good, because 2 weeks ago they were over 6.
Wow. I had someone close a loan last week, an investor in the 3s. Yep. On a triplex.
Well, if you buy it as an owner occupied,
no,
you can.
It wasn't.
No, I'm saying that's possible, or you can always buy the rates down depending on your liquidity.
It was a buy down.
You can buy the rates down as much as you want.
But that's like unheard of. I've never heard of it that low. Yep. Have you?
Not unless it's an ARM.
Okay. Wow.
And an ARM is an adjustable rate mortgage. I'm talking like everybody out there knows. An ARM is an adjustable rate mortgage. Those are in the 3s, but that means you have a fixed rate for 2, 3, 5, or 7 years.
That'd be risky today when you can get so low. Okay, so is it true that in general, bad economic news is good news for mortgage rates?
It typically can be. This whole COVID-19 has changed the whole dynamic. Normally what happens in bad economic times, people pull their money out of the stock market, they put it into the bond market. The bond market is what drives mortgage interest rates, not the stock market. What happened recently is people did not move their money from the stock market to the bond market. They were buying gold, silver, and precious metals, and that's why the interest rates went up so high. There are also certain categories, because of the situation we're in right now with 26 million people unemployed, the investors that buy the loans from the people I work with are cutting off certain types of loans or raising the interest rates to prohibit people from buying them. They can't say, no, we're not going to do your loan. But for example, on a jumbo loan, a mortgage, let's just say for round numbers, is over $500,000. There are no 30-year fixed products for that anymore.
Wow.
Those are suspended because of the risk involved. And the interest rates on the adjustable rate mortgages, the ones that can change periodically, are anywhere from the mid fours all the way up to 7%, depending on the investor.
How long can you get for that jumbo loan right now?
How what?
If you can't do 30 years, what do you get?
The
20?
longest term I've got somebody right now with an $883,000 house that they want to refinance, and the longest term we can get her is 3 years. And she doesn't want to do that because, again, the rate today would be 4 5/8 for her particular property because it's a somewhat unique property. Well, 3 years from now, who knows what the rate will be. And so it's too risky right now. So they say it's suspended. Suspended means we can't do a 30-year fix, but we can do ARMs. But if you're a responsible lender, which I believe I am, I'm not going to put someone into a product that's not going to be good for them. I'll tell them to wait. At some point, this will start to open up again. And when it does, we'll see the return of some of these products. So I guess my advice, depending on the type of product you're on, don't jump into it just because you think the timing is right or you finally found a house. It has to be the right loan term for it to be the right house.
Yeah, otherwise it's pretty risky at an
It is.
$885,000 house when you
Yep,
don't know what's going to happen in 3 years.
exactly.
Wow. So how long will the rates stay low, or are they going up?
No, and that was yesterday's call. And again, it could change, but the projection is now is we'll stay where we're at right now. When we come out of this, a lot of the American economy is driven by housing, building, selling, all that. So they're going to do whatever they can to prop it up. So no one is projecting that the rates as they are today will go up significantly. Could there be little blips here and there? Yes, but we don't see them jumping up a point or a point and a half in the near future. The biggest issue that most people are saying is when this starts to free up and people go out and start buying again, we're going to have the housing shortage again because there are nobody's building houses because they can't work because of the quarantine. So it's going to be pre-existing houses for sale. That will continue to be the biggest problem into the summer. Is basically all these people that have been wanting to buy since January, February, March, April, now going into May, are going to hit the market in June and July, and there will not be enough properties for them to buy.
In our real estate world, they are talking about, we're just going to have a late spring market, and it
Yep.
might be July and August instead of what we were looking at for March and April. It's pretty interesting though, because what about all these people who are unemployed? They were looking for a house. I talked to
Yep.
a fellow realtor today, and she said she had 4 deals, go south because they lost their jobs.
Yep. Yeah, and that is a big issue and one of the biggest changes that happened recently because of all the people that are being put on furlough, not laid off, but they're on furlough, so they're going to be called back when the freeze is over. But we used to do what's called a verbal verification of employment 10 days before closing. That window is now 3 days before closing because people are losing jobs so fast that we have to get closer and closer to the closing date to verify they still have their job. And there are, as you can imagine, with 26 million people unemployed, there's a lot of people sweating bullets because you don't know when you go into work in the morning whether or not that's going to be your last day for a month or two.
Wow. And if you're checking 3 days before the deal's
Yep.
going to close and they got furloughed,
The deal's dead. They're unemployed. Now, what happens though, one of the things that my company does, because we can make adjustments within, so let's say somebody gets furloughed, but it's only a week. You can delay the closing a week and you can close a week later.
okay.
As soon as somebody goes back to work, because I'm working for a gentleman that's a dealer at the Grand Casino up in Hinckley. Obviously, they're closed. It's non-essential. But as soon the day he goes back to work, I just need his first paycheck, and then we can close the day after I can show his first paycheck. So just because somebody is, some people, I have my daughter, unfortunately, has been unemployed for 6 weeks. If she was buying a house, I just need her first paycheck to show she's back to work. Has to be the same job, can't be a new job, unless, because we're going to have a big employment gap to explain. But we don't need to wait 6 months and have 6 months worth of paychecks. We just have to prove they're back to work.
Okay, so basically, if you can staple the real estate deal together, have the seller wait, maybe in a month, the deal will happen.
Again, my card dealer up in Hinckley wants to buy a house in Pine City. Pine City's kind of the middle of nowhere. He was honest with the listing agent and told them that he was furloughed. We're not looking to close that until the middle of June, because for sure he thinks he'll be back in time for that. But the listing agent knows where that house isn't going to sell fast anyway. So he's got earnest money. They've done the appraisal. They've done the inspection. The minute the gentleman I'm working with goes back to work, we can close on the loan within a matter of days. I do want to mention, because there's a lot of people have this misconception. In my business, we cannot use unemployment as insurance. So there are a lot of people that do my job. They're telling somebody, well, you're making more money on unemployment than you're making at your regular job, so I'm going to qualify you with unemployment. That does not work. Unemployment means what it is. It's unemployed. No investor, no lender is going to finish a loan with someone who does not have a regular income from a regular job.
That is good to know, because it would just be disheartening if someone went all the way through the process and had misinformation, and then of course it won't happen.
Well, I just had somebody yesterday that told me that the loan officer, and I'll get off my little side stories, but the loan officer didn't ask for bank statements and income documentation up front. They got everything to the point that they were within 2 weeks worth of closing. He finally had to turn in bank statements and showed that for the last 2 months, the guy's been getting unemployment. Everything he spent, he possibly will get his earnest money back. He will not get the money back for the inspection. He will not get the money back for the appraisal, because he was pre-approved under basically false circumstances. You can't pre-approve somebody based on unemployment insurance. So.
Wow. We do have a question here. Somebody just closed a loan and they said they couldn't get longer than a 15-day lock, and only after the underwriters approved the loan. Is that normal now?
Was that a refinance or a purchase?
Purchase.
I have never heard of that, because we would typically do a longer lock to assure you that you would not have your rate go up at the last minute. I will not do a 15-day lock. I do 30 or 45 days. I have never heard of an underwriter not letting someone lock for more than 15 days.
See, I think it's like the rules change so fast.
Well, there are, again, that doesn't make any sense. A 15-day lock would cost you more than a 30-day lock would at this point. Because of the number of refinances that are currently being done, companies like mine, mortgage companies, are asking people to lock for 45 days and not charging for the 45-day lock, just to give us time to handle the volume. Now, there are certain investors, and again, they would be the non-conforming investors that write their own rules, that may only let you lock for 15 days. because they want to make sure that they don't lose money. If you lock away in advance and the rates go up, they don't want to lose money because they're going to sell the loan based on the current day's rate. So some non-conforming lenders may want shorter term to protect themselves, but they're not protecting the consumer, they're protecting themselves.
Yep, there you go. That's why, again, it's good to be a broker because you got, there's different places to shop. If X doesn't work, you go to Y.
Exactly right.
Okay, and how often are the rates changing today? Is it like every day or what's going on?
4 to 5 times a day.
They are.
Yep.
Wow.
But it's not drastic changes, and sometimes it's going down, sometimes it's going up, but it's not drastic like it was again 2 or 3 weeks ago. There was half point swings from 9 o'clock in the morning till 4 o'clock in the afternoon because the market was so unstable. There was actually one point, I believe, I'm going to guess at the dates, but I'm going to be pretty close. On the 17th and 18th of March, you could not lock an interest rate for 2 days because it was so unstable. They shut down all the pricing engines in my industry. No one could lock a rate for 2 days. That's
Wow.
how unstable it was. And that was also that week and the following week when a 30-year fix jumped up over 4%. I had people that could have locked at 3 3/4, 3.85. No, we're going to wait. The stock market is tanking. Rates are going to go down. They ended up buying their houses at 4.5 and 4 3/4% because they needed to get into the house. They took the higher rate, and then 2 weeks later, it dropped down again. But you do need to have a mortgage person that you feel comfortable with that can kind of guide you through the process, because there's going to be times that your inclination is going to be that rates are going to go down because I'm going to say amateur, but because you're not an expert at it, but you're going to think that rates are going to go down. Talk to your mortgage professional and find out what they think is going to happen with rates, because they're generally going to have a little bit better information. It's a volatile market, but we kind of have a better read on what's going on perhaps than you do. And then you have to trust that person to be right.
I see there is one question there. What's a balloon mortgage and can they be a good idea? A balloon.
A balloon is, let's just say for the sake of argument, it's like an adjustable rate mortgage. You have a certain term, generally it's 5 years, that you'll be given a rate and term. It'll be amortized, meaning the 5-year payment will be based on 30-year term, but the end of 5 years, there's the balloon is you have to pay back what you owe in its entirety and get a different loan.
Usually I see balloons in seller financing or a contract for deed deal, then there'll be a
Yeah.
balloon.
I have done in my career now 8,300 loans. I have never done a balloon. I
Oh,
would
okay.
steer away from it as much as I could. So
Lots of times in seller financing, they'll want a down payment, a good sizable one, and they'll say, okay, I'll carry it for 5 years, but after that you refi it. I bought my very first investment property, a triplex I moved into, with a balloon. And you know what happened when the balloon came up? It was only a 2-year balloon.
Yep.
I wasn't able to refinance at that moment. I don't remember what was going on economically. And I was able to talk to the contract holder and just say, hey, give me another year. Here's my circumstance. He said, okay, fine.
Yep.
And it worked out.
I would just add too, a balloon mortgage is the norm in commercial lending. So if you're buying
Yes.
more than 4 units or an apartment building or a business, it's not as common in the mortgage business, the residential mortgage, but it's very common in commercial.
Yes. Okay. Refinancing, there was a big boom in March of refinancing. Is now a good time to refinance?
Yes, depending on the amount of equity that you have in your house, but most people, so there's 2 different ways to refinance it. A lot of people, unfortunately, were using their house as an ATM back in March again. There was enough appreciation, so they refinanced to get cash out. So not only did they pay off their mortgage, but they took money out to pay credit card debt, etc. That can be a good strategy at times, but that's part of what caused the mortgage meltdown, because it basically inflates the price of the house, or the house's value is inflated. If the market was to decline, you end up upside down, owing more money than your house is worth. Today, to get cash out of a house, the maximum you can do is 80% of the value of the house. So if your house is worth $300,000, the maximum you can do on a loan is $240,000, including the cash out.
Ah, okay. No matter if the house,
260, right? 260,000.
so if you have a $500,000 triplex and you wanted to cash out and you
Nope,
only owed 50.
Nope, different scenario. Now, if you're doing cash out on a triplex, you can only do 70% of the loan to value on an investment property. So the cash out percentage is even less on an investment property.
Okay, 70% loan to value right now.
For an investment property,
Right.
for your primary residence, 80% loan to value for cash out. If it's just a rate and term, that all you're trying to do is lower your interest rate on a primary residence, you can go to 90% loan to value. On an investment property where all you're trying to do is lower your interest rate, you can go to 75% loan to value.
Interesting. 90% though on
90% on a primary residence.
Okay, so then but I can't cash out. I was thinking of a HELOC, a home equity line of credit, guys, is what I'm talking about. Like, what if you want some cash because I want to buy some more investment property because the deals are going to be coming up. What's going on with that right now?
HELOCs generally so there's two different pieces of terminology. One is loan to value, and that's primary amount that you owe on the house is the loan to value versus the appraised value. A HELOC adds another terminology in there. It's a combined loan to value, CLTV. You would go to a private bank, not me, I don't do HELOCs. You would go to a private bank, a Wells Fargo, a TCF, a US Bank, Bremer, whatever. They all have different guidelines, but they'll usually go cash out to 95%. But that is all driven by credit score. So the higher the credit score, the more they'll give you. As a rule, 90% most people can get with halfway decent credit.
And the rate though is higher on a HELOC.
Oh, it's going to be significantly higher. If a fixed rate mortgage right now is just say 3.5%, most HELOCs will be between 4.5 and 5.5. And again, it's going to be driven by credit score.
But that's still, it's still cheap money.
It's still cheap money. It's still cheap money.
And especially if you're going to buy an investment property with it, because that, what I was saying is, I did a changing market forecast, or my take on it about 2 weeks ago. It's probably old by now. It's not too bad. I did a good job, a lot of research, but I said, go ahead and get that HELOC lined up now with your bank, get it in place, because then when you want the cash, even what the people I listened to were suggesting, take the money out, put it in a different bank account. Just do it now while you can do it. You can always just give it back. But then,
on a HELOC though, there'd be a prepayment penalty if you just gave it back. So you need to find out what that is. But the strategy of getting it now and putting it into your account is a good one, because as a rule, we have to get 60 days worth of bank statements. So let's say you got that HELOC in April, you put the money in your account in April, you buy an investment property in July. If I only need May and June bank statements, I don't need to know where the $100,000 came from, because it's been in your account. I don't have to source it or season it. If it shows up as a $100,000 deposit, I have to explain where it came from.
Good point. Good point. Yeah, it's all about preparation.
It is.
But you're right. I wouldn't have thought, or I didn't know. This is why I'm talking to Keith, you guys. We need to know, look for the prepayment penalty. Like that would be a big problem. You're right.
It could be significant. I also, just as a side note, and again, I don't work for or with credit unions, but if you're looking for a home equity line of credit, credit unions are good sources
Yes.
of those. It costs $5 to be a member of a credit union, and you're going to see a lot more aggressive interest rates through a credit union than you will see through a big national bank.
That brings me to my next question, because I want to talk about overlays. And you're right, I happen to be a Wings credit union member.
Yep.
And my children have auto loans there, which they went everywhere else and they were much higher. And it's the same in the mortgage business. They're a credit union. And I don't even know if it costs $5. I think you just have to keep $5 in a
But
savings
you have to put
account.
$5 into an account. You have to have a savings account.
Yeah,
You have to
big
maintain
deal.
a $5 balance. Yep. So that's $5 spread over how many years that you belong. You never have to put it in again. You just can't take it out. It has to be $5 balance. So,
But you're right, shop around. There's
yep.
nothing wrong with shopping around.
Yep.
And somebody recently asked this, is it okay to apply for a mortgage with you and go over to Wings and apply for a mortgage also? Is that okay or not okay?
You're not applying for a mortgage. You're looking for a pre-approval. And in our industry, the way it's set up, it's always, because what happens is you're going to get your credit pulled. The more times you apply, the more credit pulls. But on a mortgage application, it's what's known as a soft pull. It's going to have little or no effect on your credit score. So if you had me do a pre-approval and then you went to Wells Fargo and then you went to Wings, you're not going to see a dramatic drop in your credit score. However, let's say at that same time you go out and get a Target card, the Target card will probably drop your credit score 30 or 40 points because you're extending your credit. Shopping for a mortgage is looked at differently by the credit bureaus, and it'll have little to no effect on your score. And that part of that is there was a law written back in 2009, 2010 during the mortgage meltdown. Dodd-Frank was the legislation, and they encouraged people, bless you, they encourage people to shop around for mortgages.
Okay, and somebody else here says, how long do you anticipate will be in this good time to refi?
Let me get my crystal ball.
Yeah, take
I
a
would
guess.
say I would act now rather than later. Let me put it that way. I would never guarantee that the rates will stay the same, either up or down, but I think right now rates are pretty darn good, and you can't lose by doing it now. I mean, if they drop, they'll drop an eighth or a quarter. If they go up, they'll go up an eighth or a quarter. So right now is a good time, I think, to lock and look at doing a refinance.
Yeah, I just refinanced with Keith, I don't know, 3 or 4 months ago, and it saved me a bunch of money. So, what are the fees on a refi? Is there a bunch of fees we have to pay to do a refi?
The refinance fees are basically all going to be the same because you're going to do the same underwriting, the same processing. There's still title costs and stuff. You do have to build new escrow accounts for your taxes and insurance, but you do, unlike a purchase, when you do a refi, your former lender will give you back certain amounts of money, like your escrows. Whatever is being held in escrow for taxes and insurance will be refunded to you. So it'll offset some of the costs. But the other thing with my company, our typical closing costs, including the escrows, will run 2.25% to 2.5%. I'm seeing people out there now that are 3.5% to 4% because they're charging people points to buy the interest rate down or to just fatten the wallet. I don't know. I've never charged points in 21 years. So the only good reason to charge points is if the borrower wants to buy the rate down. But I had someone you referred to me recently that they said, well, you're telling me my interest rate is 5% for this investment property refi. I can get 4.625 from Joe Blow Mortgage. So they sent me over the cost estimate. They were being charged 2.5 points. So they were being charged $5,000 to buy the rate down an eighth of
Yeah.
a point.
Yeah.
Excuse me, 3/8 of a point. That's not
Okay.
worth it.
No, that's not worth it. It's really interesting. Okay, we have another question here. Is the credit hit for a commercial loan pre-approval the same as a residential loan?
I don't know the answer to that because I don't do commercial, but that would be an excellent question to ask whoever you're using as a commercial lender.
They're looking at things differently in the commercial world. They're looking at the asset more than your personal. Sure, you need good credit
Yep,
on all
yep.
that, but they're basing it more in a commercial loan on what you're purchasing and its stability. You still got to be standing as a pillar behind it. In residential, it's on the person's.
Exactly. Yep. Commercial property is all about your assets, your liabilities. The credit score, like LeAnn said, is a big part of it, but it's not as big a part as it is in residential. Just a quick side note, 3 weeks ago, LeAnn knows this, FHA, which is a first-time home buyer's loan essentially, but can be used for anybody, we could do an FHA loan down to a 580 credit score, which opened up the doors for a lot of people to buy homes. We recently had to raise that score to 620. Most of my competitors, including the big banks that are here in town, went to 660 and 680. Basically, what that said was, we don't want to give you a loan. If your credit score is that high, you would use regular financing. Credit score drives residential mortgage. It drives interest rates. It drives the products you can get. It drives your ability to get a loan. Commercial, there's going to be other factors, but credit score and income are the two biggest things that we focus on in residential.
I like that. And you guys stick around, because at the end, I have a credit repair guy who's actually a realtor on my team. I'm going to give you his information, because if you need some help, I got somebody who can help you. So now I noticed, like, it was a couple weeks ago where banks or credit unions, whoever, they were pulling back on HELOCs. All of a sudden they were like, we don't want to do it.
Yep.
Are they still like that, or did they open back up?
I think you're seeing that open up right now. And I think what everybody's greatest fear, and you asked it early on in this everybody's greatest fear was we were going to go into another mortgage meltdown, another mortgage crash. It's quite the opposite right now. Appraisals are probably more in line with what true value is than they've been for the last 3 or 4 years. Part of it is consumer and purchase driven, that appraised values kept going up on homes. If the appraised value were to drop all of a sudden, if the economy came crashing down, then that would be very damaging to the mortgage industry. But we're starting to see appraisals be more realistic. We're also starting to see people making offers to houses where they're not inflating what their offer price is. I hear all these commercials on radio that say, oh, Joe Blow sold my house for $60,000 over list price. Well, if Joe Blow sold it for $60,000 over list price, why did he list it at the price he listed it at? It was listed for $60,000 too low. Maybe that's a good strategy, but I'm closing on a loan tomorrow where the listing agent listed it for $20,000 higher than it should have been. And when the appraisal came back, it came back $20,000 lower than the sales price. So we had to negotiate that, because they were thinking it was last summer when you could throw a price on there, it would appraise for that. The appraisers are once again being held to a very high standard, and they've got to use current comps, recent sales. They can't go back 6 months if something sold 2 weeks ago for a lower price. So that was a long answer. I think HELOCs are opening up again. Yes, I think we're fine.
Now you brought up the subject of appraisal, and I read or heard, with COVID and everything, that they're doing some drive-by appraisals here instead of going in the house.
Yes, they are.
They are. Okay. And that's interesting, because I had a house that they shopped 2 mortgages. I'm the listing agent, and the first company did do a drive-by. Then they switched companies, so they had to have a new appraisal, and that they had to get in. Period.
Well, a drive-by appraisal, so there are many different things. Rarely on a purchase, but sometimes on a purchase, we get an appraisal waiver. An appraisal waiver means there's an automated value module that says your house is worth this much. If that's what the people are selling the house for, there is no appraisal. If you have really high credit and it appears that the house is in that AVM area in terms of price, they can do a drive-by appraisal. But the appraiser still has to do some more research because you can't tell what the inside of the house looks like. Does it have granite countertops, solid oak cabinets, wood flooring, new carpeting? So they do a lot more research on it. But because of COVID, they don't necessarily have to go into the house. If you're going to dispute an appraisal, which we had to do on this one I was talking about, the appraiser has to go in there, take pictures, and make sure that he knows everything about the inside of that house, just like a normal appraisal. So the waiver and the drive-by were seen as advantages. It was a streamlined way to do it. But if the value doesn't come in, you will be paying for a regular appraisal.
Now, if I recall, when I did my refi with you, I think they got to do a drive-by and they don't charge as much. So I saved some fees. Is that?
You broke up really bad. I couldn't hear what the question was.
Oh, I see. It says my internet connection is unstable. Can you hear me now?
Yes, I can.
Okay, good. My question was, I believe in my own refinance recently, they did either a drive-by or a waiver because nobody came in.
Correct.
And then me as the consumer, did I save money because I didn't have to pay for a full appraisal?
Yes, $545.
Nice. Okay, I got another question here. Can you help people who want to buy a short-term rental?
I'm not sure I understand the question.
Well, like, what if they want to buy a piece of property for an Airbnb? You don't care as the mortgage person.
No. I can't do that.
Really?
I cannot. Well, when you say short-term rental, we have to have leases. So for you to be able to get it, all right, let's rephrase that. Unless you can pay the mortgage payment without having to count the rental income, then a B&B becomes an issue because a B&B has irregular rent. The minute an appraiser goes in there, and most appraisers will ask, is this an investment property? And you say, yes, it is. It's a B&B. Then they're going to want to see receipts and checks and all the rest of it. You probably can't prove 12 months of solid rent. When we can't prove 12 months of solid rent, then a lot of underwriters are going to eliminate completely the rental income, which means you have to be able to make 100% of the payment without rent.
So
yes, I could do it, but there's a lot of documentation.
Unless, let's say somebody else operated it as an Airbnb and now you're buying it from them. So you have a year of history.
Yep. Then we would need the year of history from the current owner, and hopefully they'll be willing to give that to you.
Well, and to tell you the truth, like, think about this, folks. Like right now, some of those Airbnbs are in big trouble here because guess what? People aren't traveling. Unless you've been smart enough to rent your Airbnbs to hospital personnel, a lot of them, you got a big family and the dad is a doctor, the family might not want him coming home at night, so they're renting Airbnbs.
I have a lady that's what she does through Mercy Hospital. She owns 3 duplexes around Mercy Hospital, and she has a contract with them that she knows that they guarantee rent payments 70% of the year. So we have a contract that shows that one way or the other, whether it's Mercy paying or the client, the patient, someone will be renting that property 70% of the time.
Interesting. So Doug says many short-term rentals or Airbnbs go for commercial mortgages. They maybe have to, because just like Keith said, it's not easy to do.
Well, I said, if you buy a rental unit and you have leases, then we get to count 70% of the lease income as income to offset the payment. And as that person pointed out, an Airbnb generally doesn't have a lease. Most people don't have 1 year of history. We basically go on whatever the tax returns say came in, and you're only going to get to use 70% of what you bring in, because there's a 30% vacancy factor no matter what kind of property it is. So the less money you can prove coming in, the more the responsibility of making the payment falls on you. So unless you're very wealthy and can afford a couple of house payments, because most people investing own their own home, if you can't afford to make those 2 house payments, you're not going to be able to get a mortgage.
Okay, now what about rehab loans? Because I know before you had a product, a really great product that would help somebody who was going to move in and do a little rehab. What's going on there?
We still have those. Again, those are going to be considered somewhat riskier. It falls under the FHA jumbo loan, some of the cash out refis, that those are not as attractive interest rate wise as they were 60 days ago. It's not that they disappeared. It's not that we don't have them. It just, investors on my side of the business have a very low appetite for those loans because there's inherent risks involved with that they want to stay away from.
You know, and if you follow trends, folks, I have been seeing that fix and flip. It's been getting harder, and there's another reason why it's even harder again. You know, it's different to buy something, add value, and then rent it out.
Correct.
That's still going to happen, and especially some of these foreclosures that will come out. But the actual fix and flip, it's going to be tougher to get your money. And I would think the hard money guys will follow suit and kind of raise their rates too. Why not?
Yep.
It's supply and demand, folks. Okay, let's see here. What have we? If you're going to do a cash out refi and you know it's for home improvements, does that matter, or you don't care or want to know what we're going to do with the cash?
I would typically do on a mortgage application, you can put in you're going to use it for rehabbing or remodeling kitchen or something. I never use the actual justification because no, the lender doesn't care if you qualify. You can do whatever you want. If you're specific, then you have to have receipts, and they may want to see the work completed. And so if you get qualified for cash out, we just say cash out other. We don't care what you do with it.
You know, when I built my portfolio, I was back when in the 80s and 90s, interest rates were 18%, guys. And the numbers, it's all about, does it cash flow? And anyway, I would do big cash out refinances. You know, back then it was about 85% loan to value, which was pretty darn good.
Yeah.
But that's how I did it. I would buy the building and I would use the cash out refi from the prior building to do my rehab, and then keep spinning that same money. So cash out refis are great, but they're trickier now.
They're harder to get, and they're going to be a higher interest rate. So.
Yep. And now this down payment assistance, the program we had here were $1,000 down. Did it soften now? And now what's our credit score have to be?
Well, so Minnesota Housing, we'll talk about that because that's the one I use the most. Minnesota Housing down payment assistance can give you anywhere from $0 to $15,000 for down payment assistance. The bank that funds all of those is no longer guaranteeing that they will buy the loans from companies like mine. Minnesota Housing is still up and running, but the minimum credit score for that is 660 to get down payment assistance. And you have to have 2 months of payments in reserve. So if the mortgage payment is $1,000 a month, you've got to have at least $2,000 in the bank to show that if you lost your job or something happened, you could make the mortgage payment for 2 months.
Wow. So it's a lot tougher than it used to be.
It is, but you still only have to have $1,000 of your own money. You can get, the average amount of money that I get people is $8,000. It can go all the way up to $15,000 that Minnesota basically gives you a grant for down payment assistance. That money can also be used to offset closing costs and stuff that you may have. It cannot be used to set up the reserves. So you have to have the reserves in the bank. You could get reserves from mom and dad, brother and sister, a blood relative. If someone wants to gift you the reserves, you can do that.
So one more thing, I practically ate up the whole time with all my questions, but hopefully, I fit in what we had. So if you have questions, put them there. Now, I want to know, forbearance is a temporary period for a borrower to not have to make that monthly payment. So what's the anticipated outcome from the forbearances that are happening now? What do you think?
Okay, so let's look at it first, Frank, and this question has been asked to me. I have 15 people I'm working with right now. If you choose to take forbearance on a credit card or a car payment, stop shopping for a house. Because the minute you take forbearance, you're sending a signal that you can't afford to pay your current obligations. So yes, it's a tremendous benefit. It'll save people money, but you're sending a message, that you can't pay your current debt. So make sense? The second part of it is they're saying it won't affect your credit score. But I recently had a friend of mine buy a model for his computer that says when the forbearance money gets added on to the back of the loan that you haven't been repaying or the credit card you haven't been repaying, you could see a 25 to 50 point drop in your credit score. Now, if someone, and again, the person who's using forbearance probably isn't out looking for a home. But if they were, they're not going to get it if they're in forbearance now. And if they're thinking, okay, well, I'll take the forbearance and then I'll look again in the fall, chances are that their credit score is going to drop significantly. But no one knows that part of it for sure. We do know if you can't pay what you owe now, nobody's going to give you a mortgage.
How long though? Like for 6 months, you mean, or?
That no one knows the answer to that.
We haven't had this.
We're in uncharted waters right now.
Yeah.
One of the biggest concerns we had, which has benefited several of my buyers recently, is how would the stimulus money work? Since people were getting $1,200 to $2,400 in stimulus money, that has not been a barrier whatsoever. It's helped several people put a little bit more down or need a little bit less in seller paid closing costs because they got their stimulus money. So that's the only thing that hasn't had a negative impact and in any way, shape, or form. And we were all nervous about that because we were going to have to, how do you explain why they got stimulus money? The government gave it to them. And that's basically what the investors and lenders said is it came from the government. As long as it says it came from the IRS, we don't care.
Okay, that's good to know. Now,
Yep.
So, what about loan modification? Would it be better to just maybe miss 2 payments, don't do the forbearance, like sort of miss them and then go in for a loan modification?
Typically, again, I have not dealt with this in a while because it hasn't been a popular, I can use a family member as an example. When you first of all, to get a modification, you have to miss 3 payments. That's the general rule is you miss 3 payments. If you miss 3 house payments, the damage you've done to your credit score is going to take years to repair. And yes, they did drop her payment. And yes, it made the house more affordable, but everything else went up. Her credit card interest rates went up. Her car loan, when she went to get a car loan, she paid over 20% interest for her car loan. So whatever the benefit was on the housing payment side was all hurt by everything else going up the minute her score dropped. So
see, it's really interesting because someone I know, when, the way that they presented this forbearance information, they went out right away and got it, like not knowing for sure if they needed it or not, just went ahead and now they're going to pay anyway.
Yep.
But now they've dinged their credit.
Well, hopefully, if they're still paying it, then it's not in forbearance. It'll still show up as a payment.
But they called and arranged it or whatever.
Well, then they need to call back and say, we don't need it. But if they're making the payments, the creditor, the mortgage company has to report the payments. With forbearance, it'll show up coded in a credit report that it was forgiven and deferred it'll be like a student loan. It'll be a deferred payment. But if they're still paying it, they shouldn't even be in that program because they don't need to suffer any negative impact from it.
Right,
if they're
because
still
they're
gonna
gonna
make the
pay
payment.
it. Yeah. Okay, so this is the issue with COVID. We get information and then we get a lot of wrong information. Like this is how PPP and EIDL and all these different programs, it was so confusing.
Yep,
And mortgages like that for so many people. And
absolutely.
it's confusing to me, but thank goodness I have you who will always explain it to me, and then I can explain it to the people. And so I just want to bring up, we got one last question here. Freddie and Fannie, oh, for an investor is, the rule where you can have 10 loans.
Correct. Yep.
So it says, but this is also limited by 12 properties in your name. What does in your name mean?
Means the title and the mortgage are in your name. They're not in an LLC or an outside entity. So you can own 10 properties in your name. You can't have more than 10 properties listed as LeAnn Riley as the owner of the home.
But if I was married, can my husband have 10 in his name and I can have 10 in my name?
You theoretically could, as long as you could each individually afford them, because you wouldn't be able to use the other's income or assets. You'd be a single borrower.
What about this? What if we got the loan in his name and then transferred it over to my name?
The mortgage would still be in his
The mortgage
name.
is,
The title would be in your name.
Okay, gotcha. All right.
Somebody else just typed something about 10 loans.
Yeah, that's what I was looking at.
Oh, I just saw it flash up again.
Yeah, that's the one I was asking you. Okay, I'm going to share screen here now, folks. And
before, I just wanted to add one thing.
Okay.
So I have 5 properties paid for, then I can only have 5 more loans. If you have 5 properties are paid for, you have 0 mortgages, so you can get 10. If you own them free and clear, it's the mortgage that is what determines you can only have 10 mortgages. It's not that you can only have 10 homes, you can only have 10 mortgages. So if
that's
you own,
good news for whoever
if you
wrote
own
that.
them free and clear, then you don't have to worry about it. But LeAnn mentioned about things are changing very quickly, and I'm not exaggerating. I spend 2 hours a day, once in the morning, once in the afternoon, reviewing guideline changes. That's how quickly they change. To me, it's important that I work 7 days a week. I will answer my phone from 7 in the morning till 7 at night, 7 days a week, because you're not supposed to try to figure these things out by yourself. You're supposed to have, I like to think of myself as a trusted advisor. If you have concerns or questions, I'm accessible to you every day of the week. And I want you to know that if you choose to work with me.
And he's telling the truth, you guys, because I have texted Keith at ungodly hours, and it is so great to have a straight line to get the answer and be able to solve whatever the issue is that's going on in the real estate deal. And that's why Keith is my trusted partner. Now
that's why I love getting requests from LeAnn at 11:30 on a Friday night for a pre-approval letter, but she gets it.
We get it. Now I'm going to share screen, guys, because I've got some info for you, and this is where you might want to take it down. Can you see the screen, Keith?
Yes.
Yeah, okay, so this is the Right Score Credit Repair. If you have some credit issues or someone with credit issues, this is Eric Jansen, and he's actually a realtor on the Encore investment team. So not only can he help you find a house, he specializes in rent to own, and he also can help you with your credit. So I think more and more people are going to be needing credit repair. So right there, rightscorecreditrepair.com is how you can find Eric. And then I have a slide here. Whoops, got to get over there. You can have a free strategy session with me if you want to chat real estate. And how you get that, you can actually, if you go on my website, it's almost easier, leannriley.com. There's buttons there under real estate for a free strategy session. And then I'm going to leave you here with, this is Keith's contact information. That is the secret phone number, guys.
Yep.
And there is his email. So if you have a mortgage question, he is happy to help. But boy, Keith, you really did share with us. I mean, I asked all the questions and I knew what to ask. And I think that's why we didn't have that many questions. And you answered all of them while you were at it. So that's pretty good. Let's see here. Somebody put something in the chat. Okay, they put my free strategy session there. All right. So Keith, thank you so much for just being available and being so smart about lending and really being able to help the people that we always send to you to get it done.
It's my pleasure.
It is. I appreciate that. And, you know, it's really interesting. If you're thinking about selling, now is a very good time because just as he said, the prices are holding really well. We have COVID responsibilities as realtors. We can handle all of that, keeping everybody safe. And we're getting multiple offers and things are selling. There's not that much out there to choose from. So if you're thinking about getting some cash for the next deal when our deals are going to be coming up, now's the time. So thank you everybody for joining us, and be sure, and everybody here has joined the LeAnn Riley Real Estate Investing Club. If you're curious, you can go to Facebook, and I have a Facebook group also called that, LeAnn Riley's Real Estate Investing Club, and you can get up-to-date goodies on that Facebook group. So thank you, everybody, and we'll see you next time.